Friday, December 30th, 2022, Maneco 64, home of alternative economics and contrarian views. So today we're going to look at whether the banks are safe, whether there are cracks starting to show in the banking system, the whole derivative system as well. And yes, whether our funds are safe in the banks. I know there's FDIC insurance and FSCS insurance in the UK, but would it work during a systemic crisis? Before I go any further, I'd like to say, if you enjoy this video, make sure you hit the like button. If you enjoy my videos in general, make sure you have subscribed and hit the little notification bell. So Wall Street Silver tweeted this out yesterday. They don't want the public to see this video. The bankers don't trust the banks, and apparently it's from November 2022. I don't know where they got this clip from. It says they're talking about financial crisis and their lack of faith in our banking system and how to keep the public from freaking out. Federal Deposit Insurance Corporation. So it could be a meeting at the FDIC. I'm not sure, but I'm going to let you listen to it. It's just over a minute.
I don't think you have much hope of reaching a public that doesn't have a professional need to know.
I completely agree with that. I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank? Like, my insurance company doesn't tell me what they're doing with my assets. They just assume they're going to pay my claim, right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do. That we want them to have full faith and confidence in the banking system. They know the FDIC insurance is there. They know it works. They put their money in. They're going to get their money out. So there's a select crowd of people that are in the institutional side. And if they want to understand this, they're going to find a way to understand this. There's a bunch of law firms represented in this room. There's a bunch of people that charge them by the hour a lot of money to explain this all to them. And it's fine. I don't have a problem with that. And they all have huge staffs. But I would be careful about the unintended consequences of starting to blast too much of this out in the general public.
So there you go. FDIC. So what does the FDIC provide? Well, FDIC insurance, what is covered under deposit insurance and how much? It says the FDIC protects the money deposits placed in insured banks in the unlikely event of an insured bank failure. Each depositor is insured at least $250,000 per insured bank. So if you got $500,000 in a bank and that bank fails, you'll get 250, but you'll lose the rest. So maybe that's why it's good to have your funds at different banks. Sometimes I guess that's not convenient. And this applies not just to individuals, but also for corporations, any kind of institution or person that has the funds in the insured bank. And back in I think it was 2013 or 14. I'm not really sure which year it was, but when Cyprus, they had their banking collapse, the insurance was up to 100,000 euros. And a lot of businesses lost a lot of money because they had like €1 million in the bank for cash flow, and they lost 900,000. They got the 100,000. And I would say that if we have a 2008 like a scenario where all the banks were going under, would the FDIC be able to cover all that? And I wasn't able to find it, but I remember that back in 2015 or 16, the Obama administration embedded something in the National Defense Authorization Act that usually comes out at the end of the year. He embedded that the FDIC would be used to backstop derivatives for the big Wall Street banks. I'm not sure if that still applies, but I wouldn't be surprised if it does. And we're noticing as well, not just people in the alternative media like me and others, gold bugs and sound money proponents, but also people like Bloomberg. They're starting to notice things as well. This is from the 19th of December. Billions of dollars in Fed discount window suggests all is not well in banking. How much is that money in the window? The one with the stigma attached to it. So why is there a stigma attached to it? Well, because if a bank can't borrow money from other banks in the market and has to go to the Fed, that means that that bank is probably in trouble. And this Fed discount window is rarely ever used. And there's so much stigma attached to it that this article points out at the end here. And they say it's good news. The good news is that Dodd-Frank rules implemented in the aftermath of the '08 crisis also require the Fed to publish the names of those tapping emergency lending facilities following a 2-year lag. So we only have to wait until 2024 to officially solve the mystery of just who has been tapping the discount facility in 2022 and why. So Bloomberg thinks this is good news. I think it's bad news because if you have money with those banks, as those guys were saying, those in that clip before, they want people to keep their faith and confidence in the banks, and it looks like they don't have much faith and confidence in the banks themselves. So I'm not sure this is good news. So let's look at the this discount window facility, and of course the Fed provides data regarding that. It doesn't give the names, of course, of the institutions tapping that fund, but you can see here during the '08 crisis, it skyrocketed, that facility. It went up to like end of October. People were tapping, or banks were tapping, about $112 billion. And it's interesting that only bank holding companies can tap the Fed discount window. And if you look at here, if you go back in time and you Google Goldman Sachs becomes bank holding company and gets Fed bailout. Well, I typed that. And to become a bank holding company would take a long time. But the Fed basically over a weekend allowed Goldman Sachs and Morgan Stanley to become holding companies because they were failing. They're going to go under and they needed to borrow the funds from the discount window. So that was 22nd of September 2008. So you go back to this chart here and you look at when this Fed discount window started going through the roof. It was just after the 17th of September. So yes, Goldman Sachs got bailed out by the Fed. And then we had 2020. We had a big spike as well. Not as big as in 2008-9. And now it's starting again. Yes, it's still pretty low compared to the previous two crises. But I think we need to keep an eye on it. If you look at the shorter term chart, the 1-year chart, it's gone from almost nothing to like almost 10 billion back at the end of November. It has come down a bit now, but we need to keep an eye on this, on the banking sector, whether there are cracks in the banking sector. And is this just in the US? No, it would affect all the banks, all the too big to fail banks in the US, in the UK, in Europe, in Japan, Australia. I would say all those banks, because they're all interrelated. And the other thing that we heard recently, maybe about a month ago, is how there's about 80 trillion, I think it was the BIS who reported that, back in November. 80 trillion of non-bank derivatives out there that no one knows where it is. And I would argue there's hundreds of trillions of over-the-counter derivatives. As Warren Buffett said, derivatives are weapons of mass financial destruction. And even Bloomberg's starting to cover this. They have an article and a clip here, which I'll put below in the description, the link. 65 trillion of derivatives debt sparks concern. There's a hidden risk to the global financial system embedded in a $65 trillion of debt being held by non-U.S. institutions via currency derivatives, according to the Bank for International Settlements. I think it's even more. It's about 80 trillion, really. They're probably just counting the non-U.S. institutions here. And this is just foreign exchange derivatives. We know that interest rate derivatives are by far the biggest kind of derivatives out there, and the over-the-counter derivatives as well are the biggest ones out there, and they're not regulated by an exchange. You don't get transparent data, and they're thought to be north of a quadrillion dollars, which is 1,000 trillion. So it's crazy. And the other thing that this problem at the discount window could be showing is that the lack of liquidity in the market. And we've seen that this has been one of the problems for the treasury market, that there's low liquidity, despite the fact that there's over 2 trillion out there of reverse repos to help these people. The other indicator I wanted to show you, and this is a little more technical, but it's the spread between the Ameribor, which is the American version of LIBOR. So it's the American overnight rate, where you can borrow, financial institutions can borrow with no collateral, minus the SOFR rate, which is the secured overnight financing rate. So if the Ameribor rate is a lot higher than the SOFR, it means that there's trouble in the overnight financing market for the banks. And as you can see here, this is from Fred as well. This spread is going up quite a bit, and it's higher than where it was back during the 2020 market crash. So that's another sign that there's trouble out there in the banking system, and we're going to keep a close eye on this. And it doesn't surprise me, of course, that there is trouble in the banking system. And another reason to not have too much parked with the banks, I would say. I've always said that since I started this channel, and that's why gold and silver are so important outside the system, of course, not with the banks or brokers, but physical gold and silver. So with that, we're going to look at the markets for the final time this year, 2022. Not doing the Mike and Mario show because Mike is taking the week off. So we'll be back to that next week. And today I've got one of my Billy mugs. Billy says, snore on and keep stacking. Yes, I haven't forgotten Billy, and I never will, even though we're going to get a new puppy. So it's 10 to 9 a.m. London time. We've got spot gold at 18.18, so it's up about $3. High's been 18.22, low has been 18.13. Silver is trading at 23.85. It's down 4 cents. It's been as high as 24.12. I got up this morning. I had a quick look at the markets. Silver seemed to be breaking out. And then I got ready, came down, and turned my computer on. And this is what happened. Look at this chart. They just came and smashed it. Looks like they want to keep it below 24. I'm not sure they're going to succeed. The Dow futures is down 108. NASDAQ 100 is down 65. S&P futures is down 17. To the currencies, we got sterling up a tenth at 120.67. The euro is up a tenth as well, 106.72. Dollar's getting hit hard versus the yen. It's down almost 1% at 131.82. Dollar's down 0.25% versus the yuan at 695.73. Just a quick look at the dollar index. I think the key level there, I don't look much at the dollar index, but we're approaching the highs here from January 2017, which I always thought was like a key level. And yes, it's around 103.86, so you can see the dollar index is testing that level. If we close the year below that level, it could be a negative sign for the dollar versus the major currencies, because that's what the dollar index is really. It's measuring it mainly against the euro and the yen. To the other currencies, we got Aussie dollar up a quarter at 67.94. The dollar's down a tenth versus the Canadian dollar, 135.30. Kiwi dollar is down actually versus the dollar about 0.2, 63.36. To the commodities, and yeah, platinum broke out, or is trying to break out. It's at 1,054 or thereabouts. I think it's looking a little bit like silver also. We are at key levels. I don't think it has broken out completely, but it's looking better. We've got WTI crude oil up two-thirds of a percent, just below 79. Brent crude is up 2/3 as well, just below 84. High-grade copper is unchanged at 382, and U.S. nat gas is down just over 1% at 448. We're going to quickly look at the bond market, see where rates are this morning. We've got the 10-year rate pretty much unchanged at 384, U.S. 10-year that is. Let's quickly look at the U.K. 10-year rate, 10-year yield. That's up another 6 basis points at 373. The 30-year is up 8 at 402. And the 2-year is up 2 at 364. So bond markets are not out of the woods. That's not going to help liquidity in the markets. That's not going to help banks because they hold a lot of government debt. So there you go. With that, I wish you all a great rest of the day. Take care. Bye.